Alright folks, welcome back. I appreciate your patience. I know I promised you a video around 4 o'clock in the afternoon, but we've had some weather come through and I was afraid if I worked on it, it would cut out and I'd hate to have to redo it again. So here we are. So I want to talk a little bit about bread and butter setups and how you can go in and look for things that are kind of like in between the major setups. So some of the things that I do publicly, I share a lot of setups that aren't really big, huge monster moves, but they're trades that are very easy to spot. They repeat more often than not, and the framework around them is pretty simple. It doesn't require a lot of moving parts. It just requires basically a sentiment idea and the daily range. So obviously we mentioned on the weekend commentary that the euro dollar had traded down into this buy side imbalance, sell side inefficiency. We saw that here on Friday. So the trading that takes place on Monday, since it's a day that I'm not really anticipating a whole lot of market activity, or let me say it this way, I'm not expecting a lot of volatility and one direction. So if I'm going to be scalping, if I'm going to be looking for setups that have a limited payout but still offer me a small number of pips. Now, what's a small number of pips? For you, it may be 5 pips if you're a scalper. And there's really ultimately nothing wrong with that if you're looking for some kind of a volatility play intraday. I personally look for 10 to 12 pips minimum. If I can't get that, then I'm not really interested in taking it. Now, that's not to say that I can't go in and find less than 10 pips and build that up to like 100 pips in a day, even with a small range. I'm not saying that as an enticement for you to go out there and try to hurt yourself doing that, but over time you're going to learn there's a lot of ways to do that, and you don't need to be holding out for that one particular setup that pays 50 to 75 pips in one haul. I try to teach you as a new student to focus there first, because frequency and over trading is harmful when you don't know what you're doing. Over time, gradually, and I'm not suggesting, especially for the new folks that just started in my final class here in 2021, you are not ready to do a lot of the high frequency trading. Don't think that you are, you aren't, okay? But this is not a high frequency trade setup that I'm going to cover today. Again, it's filed under simple bread and butter setups, something that is likely to unfold, and if it doesn't pan out, no skin off your back, it isn't going to hurt too bad, and it allows for relatively small stops because the payout is relatively small as well. Now, it leaves room for a 30 pip or 40 pip type move, but you're going to see that it doesn't really require you to get that. So we're going to be focusing primarily on, so inside this daily range, we're focusing on that. Now, before I drop into the lower time frames, I want you to take a look at where the open is relative to the close. Now, this opening price is not based on midnight. Okay, it's based on 1700, and while I don't care to follow the daily range construction like that, I use the New York midnight time frame, and we're going to use that obviously in the scope of this discussion. Okay, so we have a hourly chart here, and again, this is that buy side imbalance, sell side inefficiency premium high. So without using an indicator, without pulling up any kind of like percent R or RSI or stochastic on the daily chart, we already know it's been pressed down, and it's basically the definition of oversold. But because it's oversold doesn't mean anything. The fact that we traded into this area here, which is a discount array, doesn't mean that this is the low. It doesn't mean it's going to go to 1.25 from here. All we're looking for is a volatility play, something that we can align ourselves with for a simple bread and butter setup. Bread and butter means you get paid with it. It's an income trade. And that's what I want to focus on this week. How to get your mind thinking income setups, not get rich quick or huge R multiple setups. You don't need that, folks. All the influencers out there that you're seeing, 90% of them cannot trade. And they're not taking those big R multiple trades down with a live account. And really, they're not even doing it with the demo account either. So I want you to gravitate towards this initially once you start seeing the volatility that's available intraday. Now, some of you are not going to want to trade this way because it's in time frames you're not comfortable with. And that's okay. For now, just study this because it's helping you read the tape. And reading the tape is understanding the fluctuations and delivery of future price moves. You're not looking at indicators, you're just reading the ebb and flow of price action. So we have the midnight time frame delineated here, and that candle starts the day. Okay, so this begins our true day. Everything prior to that really is insignificant at this moment because we already know what? The daily is extremely oversold. We're inside of a discount array. Don't even concern yourself with any of this right now. All we want to do is watch and see what does London do, because what we're going to be doing is building a case for what is the likely scenario for that daily range. We're not trying to capture the low of the day. We're not trying to get a buy below the opening price, which that does offer. You've learned that from me. But we were focusing primarily on the New York session, that bread and butter period of time in the daily range where we have all of the advantages of having London session behind us. All the hard work is done for you. All the uncertainty about what might be transpiring for the daily range being bullish or bearish, those factors, those signatures, those hallmarks are already in the marketplace at 7 a.m. New York time. So when the New York open kill zone begins at 7, you already have an advantage that retail traders don't even concern themselves with. They're just following indicators. So did we see the market trade below the opening price at midnight in London? Yes. Did it react bullishly while we were in a oversold condition and inside of a discount array, which is that buy side and balance, sell side inefficiency on the daily chart? Yes. It rallied higher. And it pressed higher as we went into 7 a.m.'s New York open. Up here, you have buy side liquidity. That is going to be a draw on liquidity. Now, this is for your notes, okay? When I say it's a draw on liquidity, this is going to act like a magnet. Now, for a moment, close your eyes and imagine that you were sitting in school again and you had that little wooden top desk and you had a magnet underneath the desktop. And a friend or a teacher came over and dumped a number of paper clips. Now, it's not important how many paper clips there are, but they're dumping them on the desk. Now, without opening your eyes and without actually being there, you can reasonably expect that the majority of those paper clips are going to congregate at the location that that magnet is underneath that wooden desk. When you open your eyes up, you're still going to see paper clips scattered about. But the majority of those paper clips are going to be right where that magnet is. That same phenomenon is what I internalize when I'm looking at price action. I believe that that magnet is right here. So it's going to draw price up to that. It may not get all my orders off there. How do I know that? Because I do partials. I teach you partials. So as the market's trading higher, if it offers me an opportunity to take something off, because my trade might be one of those paper clips that never make it to right where that magnet is. And guess what? In reality, yours aren't always going to do that either. In fact, sometimes the market isn't going to go to those highs. It might just fall short of it. Now, I personally believe that this is likely to be swept. But in the scope of the daily range, I want you to think about what's likely to occur, and then loosen your grip on perfection because it's going to evade you. Don't chase that because that's going to make you feel like you're never going to get it when you don't need to have perfection to do well or grow wealth. So let's take a closer look inside of all of this price action. Down in here, we are inside of a discount array that buy side imbalance, sell side inefficiency on the daily chart. We're oversold. The New York open at midnight is at the low of this candle here, and we have a bullish candle starting that whole true day scenario. It runs below the opening price in London and rallies higher. It starts to have a correction in New York. Is there anything on this chart that you see prior to this decline that would have been interesting or noteworthy in price action? The fair value gap. So right in here, as the market has moved higher, it's likely to go here. We don't need it to go there entirely, but it's likely to go into this fair value gap and then reprice to get to these highs. Now that's the underlying framework. So when you're looking at setups like this intraday, and this is what I'm doing as well when I'm sharing the examples with you all and on YouTube, I'm looking for the underlying framework that allows me the potential to make the profit. Now, I'm not requiring it to be 10 to 1, 20 to 1, 50 to 1. I just need to know that it's likely to go up there. And if it moves 10 to 12 pips, maybe 15 pips, then hey, if I'm in front of the screens and I'm able to do it, why not? It's free money. So I'm going to go after that if the opportunity presents itself. Now, while you're developing, you want to be studying price like this, but you do not enter a demo trade, you do not enter a paper trade, and you certainly don't put a live trade on. You don't learn that way. You're reading the tape by watching these levels. When it trades into it, does it react like you're anticipating it might? What do I mean by that? Well, if we have these levels here indicated on the hourly chart, and we've priced a run higher than that, and we're entering 7 o'clock in the morning New York open, it's likely to get up here, but we don't want to buy it up here. We want to see it drop. We want to be buying as prices declining. That's the best way to get efficient fills, and that's how the bank traders trade. They want to be in deep retracements, preferably, but if you have areas of inefficiency like this, as the market trades down into that, right away, you should be anticipating the turn. When is that market going to reverse? Is it starting to go higher? And does it go completely down into that? Don't require that. Institutional order flow entry drill would be this candle's low. So all it needs to do is trade back down into that level right there, and that'd be enough to be a buyer. Is there that much of a difference between this level and this level here? No. It's not a lot at all. So if you're looking to be a buyer here, you could be a buyer at institutional order flow entry drill there, and that would fill you with the spread up here, and just simply use this low below the fair value gap. It's not a lot of pips. Incidentally, as a reminder, institutional order flow entry drill, the discussion and when I first brought it up and started teaching it, it's not in any of the monthly content. It's actually taught in the commentaries. So if you use the forum, do a search on the letter IOFED, it'll pull up all the videos that I highlighted with that in its description. So we have the New York kill zone here with the fair value gap. It trades down into that, and we would anticipate watching it go higher. All right, dropping down to the 15-minute time frame, I'm going to teach you a little bit more about the change of state of delivery and order block theory. So we have the New York open kill zone here and that fair value gap that we outlined on the hourly chart, and we can see that New York open right here, and it drops down into that at London open. So we have all the hallmark signatures that this is going to probably go above for that buy side liquidity. Do we require that? No. But I want you to look at this overall price structure, and do you see an optimal trade entry? Chances are you probably don't. So I'm going to show you how order block theory can be used with the power of 3, the range for the intraday for a daily candle, and trading in sync with a draw on liquidity. So all of that being said, I want you to take a look at the candles opening here, these consecutive down close candles prior to this run up. That price right there, when we go above it, not above this candle's high. Remember, these act as gaps. All the wicks and the tails in the candles, they are gaps. So we go right to the opening or close of the candle for order block. The bulk of the volume is going to be inside that candle's body. So since these are down closed candles, we're focusing primarily on that opening price. If you anchor your fib from that opening price up to the high here, because as soon as this candle right here crosses over that opening price, that's when the state of delivery in the algorithm registers. Now it's bullish. Okay, it's running on a bullish macro. What that means is the market is going to be trying to reprice to another level of liquidity above the marketplace, because right here at that price, when we cross over that, that's when the delivery state has changed from what was bearish to now bullish. This doesn't even mean bullish to me at all until we clear that opening price. It does not need to go above this high for me to see the change in the state of delivery from bearish to bullish. That price right there, as soon as it crosses over, then I'm watching that. Okay, so you don't see this in price. You don't see this in Fibonacci. You don't see this taught anywhere else. I'm teaching you behind the scenes what the algorithm is doing. It's referring to that price right there. Right when it crosses over that, my mind is anchored to that and then how far we're going up. I don't need to put a fib on, but I'm drawing the fib for you to be able to see it graphically where it becomes oversold again. What is our representation of oversold? Well, in this case, the dealing range is the opening price here to however high it goes prior to New York open kill zone. So this is the high. The fib levels are 62, 79% retracement, extend the amount in time. You can see we went into optimal trade entry during New York open, and look closer. Do you see anything else? Inside that range right there, that is your bread and butter framework. It's beginning in New York open, and here's your profit taking London close hour or hours. This is the time you're looking to take profits, but this is where you want to see it draw towards. So remember in your notes, a draw on liquidity means that it's likely to get there, but it doesn't require your trades to get there for profitability's sake. It's very important. This is the main takeaway on this lesson. You do not need that buy side liquidity pool to be tagged intraday for you to make money. If you're buying down in here, how much of a range do you need to make money? 10, 15, 20? Does it offer that? Yes. And it doesn't even need to go up to the buy side liquidity. So many of you are so concerned about having your exits be above the old highs or below the old lows. And you see many examples of me sharing very publicly and candidly where I'm exiting many times before that run on that buy side liquidity or below that sell side liquidity. I'm doing that to constantly remind you with illustrations and examples that you need to fund the trade. You need to take the position from potentially profitable to on paper profitable or likely to be profitable, but that's not realized gain until you actually take something out of the trade. So you have to do that. No one's going to do it for you. I can't do it for you. And your broker's certainly not going to, hey, take some profit here. You need to have something in place, some kind of procedure or protocol for you to do that. And it may be a minimum threshold of 10 pips, 12, 15 pips, 20 pips, whatever, or some threshold before we get to that level that would be the buy side liquidity. And there's nothing wrong with that. That's actually a good thing. That's something that a sound money management focused trader would be doing, not the trophy chaser. Okay, it's important that you make that distinction early on in your career, that you're not trying to be Instagram level perfect. You're just trying to make money. That's what this is. This is bread and butter. This is getting the bills paid. This is keeping you from going to work for whoever and being a slave for the rest of your life. That's all this is. Okay? So that shaded area, that's your framework. That's your embodiment of this setup relative to time and price. So this is the time window. So let's dig deeper into the elements of price. Did you notice that breaker here? We have the low here. It's a swing low. Right below that's going to be what? Sell stops. Here is the highest up close candle. You extend it out in time. Bang. Hits it. So you missed this one. Big deal. Isn't this returning back into an area where we would reasonably expect to see what? Buying. Why is this a level that would be classically referred to as resistance turn support? Because we have this element here. The low, high, lower low. Then it rallies through. That means we can get this scenario here as a bullish breaker inside of the New York Open kill zone, and as it's trading down, remember that's one of the signatures we like to do. We're buying it as it drops down, and we're buying it here as a drop down. So we could be a buyer here and add more, or if we miss this, we could be a buyer here and look for it to run up here, but we don't require it to get there to be profitable. Look at the range from here to here. That's enough to make something. It's not a lot, but guess what? If that 10 to 15 pips has $50 per pip on it, now we're talking, right? How many of you are making that much money in a day? And then we're not even talking about a day here. This is about an hour and a half. So you have to think about what you're doing from a business standpoint and probability. Yes, it might go above that high, but if it doesn't, and you've taken something off, does it really matter if it goes up there now? No. Many of you actually are trying to get so good at this, you can't wait to go to social media to share it with everybody because it makes you feel significant. Don't do that. You're not trading to be significant. You're trading to be wealthy, independent, not needing to work at your job. Some of you might want to stay at your job. I'm not trying to discourage you. I'm just saying that it provides the means to do it. At least another source of income that could easily outpace your job, regardless of what career you're in. This framework here is the things that I've been teaching you, but when you start stripping it down and putting them together in a manner where you can anticipate the daily range when it's oversold on the daily, when we have all of the signatures here behind us in London, if this is where it's likely to go, because it's a likely draw on liquidity, it might get up above that 119.25 level. It might. But what's below that 119.25 level? 119.20 institutional. So it's reaching to that level there. So what would be a reasonable level to reach for if you're being a buyer here and or here? Try to get to that 1910 level, because it's a nice round 10 level, and then the 20 level. If you can get the 1920 level, peel off something there, you're doing it right, because there's going to be a lot of orders around that institutional 20 level that's going to come in the form of commerce, global transactions, bank to bank, handshaking. In other words, they're working together for liquidity's sake. You'll be able to put your order out there in that price and that time. What time? The profit taking loan and close period. So it's offering you the opportunity for a bread and butter setup that isn't going to be one of those you go out to Instagram or Twitter or YouTube and say, I'm killing it. But these types of setups happen every day. They're there every single day. And if you start growing comfortable with this is what you're aiming to find the most of, not these big, huge moves. If you can find these types of setups and get really good at it, you'll never need a job. You'll never need to stay at a job, and you'll never need to fear losing trades because these come up a lot. So what I'm showing you here is two areas where you could have taken what would be considered in my definition a bread and butter setup. But what is that specifically? It's income trading setups. Okay, that's the whole nature of what I'm going to be preaching on this week. The buy side liquidity, if you're bullish, need not be taken. Okay, even though it's likely to happen for you to be potentially profitable, that's the focus. So do you need that level 119.25 to be traded to? No. There's nothing wrong with taking that profit ahead of time. All the books say, oh, you're scared or you have weak hands. you don't want to hold out for that. Well, how many times while you're learning and developing have you thought something was going to happen and it was offering you something, but you weren't thinking, I'm going to take something off here because you want to see perfection unfold? That's the trap. As a developing student in this field, in this industry, your premise to entering every trade is I need to get something out of this. And I don't care if it's 10 pips or 15 pips. I'm doing something because I've initially opened myself up to risk. I've invested time. And I need to have a transaction that measures growth. If you get into every trade expecting your targets to be hit and nothing short of it is acceptable, you're going to be frustrated and your bottom line isn't likely to grow. And that's a very difficult place to be as a developing student in this industry because we're measuring what? Success. And that success is measured in what? Dollars. Is it more in your account or is it less? And you're constantly giving that grading of yourself. Is it growth? Am I developing? How do I know I'm developing? Can I go to my account and see my demo accounts going higher? Or can I go to my live account and see that it's now higher because now I'm a charter member, I've worked with my model, I've figured out what it is I want to be doing, and I'm not rushing to get into live trading? If you're making payments here and you're trading with live funds, you're doing it wrong. Period. End of story. And I'm not going to say any more in this video, but it's worth mentioning again. So looking at this, buying in here, so you're buying the sell stops. You're inside the New York Open, and it's optimal trade entry relative to the overblock. Here as a buyer, or here on the breaker. 10 to 15 pips, easy. Now, the problem is the stigmatism that's been placed on 10 pips. Oh, you can't trade well because all you're trying to get is 10 pips. 10 pips. How many times does that offer an opportunity to do that inside of a week? A lot. You can build that up to several hundred pips if you learn this skill. This is what I wanted to do as an S&P trader. I needed to find a small threshold of handles, okay? And all I wanted to do was make 2 to 3 handles. And that would be basically, a minute or two of trading today. That's how much volatility we have in the indices. But that 2 to 3 handles at $500 per handle, think about it. That's $1,000 to $1,500 per trade. How many do you need of that? You don't need a lot. Certainly don't need a lot to do well enough to stay away from working, right? And that was what I was aiming for. When you look at your trading in Forex, and it doesn't really limit itself to Forex, it's everything you're trading, whatever asset class you're trading, think of it like this. So all of us at some point had to submit to some full-time job. The requirements of 40 hours a week spread over the course of 5 days or whatever. And whatever that rate of pay you submitted to, I'm sure you can agree that it was too little. But you figure out what you would be doing in your trades and you grow towards that goal of what you earned in 40 hours. You want to find that in 2 or 3 trades like this. Let that be a goal. Over time, you're going to find that you're going to be able to do this just about every single day. Now, it doesn't mean you're not going to have losing trades. It doesn't mean that you're going to have opportunities missed. You'll anticipate something and you'll try to get in and it runs without you. That's no different from you going out and having a flat tire or getting sick or your child needing to go to the hospital, God forbid, and you miss a day's work. That's loss. Why is it hard for everyone that's in this industry to accept the fact that you're going to have things come up like tonight? Real world. The weather kept me from meeting my deadline. Some of you are probably scratching your head like, where's he at? Well, the same thing's going to happen when you sit in front of your charts. Just because you plop yourself down and you're ready to push the button to get in doesn't necessarily mean you're going to have that opportunity presented to you, and your nimbleness in your observation of price action isn't going to be aligned for you to jump in there right away. It won't be. But over time, you'll teach yourself to see these things, but it'll present more opportunities that you're not really seeing right now. So I taught you a little bit tonight about order block and the change in the state of delivery once we cross the opening price. That's where your anchor point is, because that's what the algorithm is focusing on. It's not looking at that high. It's looking at that opening price. So if you're going to anchor your fib for measuring your dealing range high to low, it's this opening price to whatever the high is prior to New York. Why are we focusing on that? Because London has shown the signatures that we like to see while oversold inside of a daily discount array or net buy side and balance sell side efficiency. It's likely to reprice higher. If it does, we see this signature here, which is classic power 3. It goes below the opening price, accumulates orders, and then rallies. Your eye goes right to that opening price. When it changes the state of delivery right there, you're not worrying about what if it comes back down and fills in this. This isn't a gap. That's not an imbalance either. This is a redelivery. This is the change in the state of delivery right at that price there. So you anchor your fib to that, oversold relative to the optimal trade entry. It takes sell stops. Boom. Right away, that is a barn burner of a setup. If the narrative is correct. What makes the narrative? All of the backdrop over here with that daily chart being oversold without needing to look at an indicator. We went into an area where they're likely to pick up orders. The algorithm flags that run into the opening price, and as soon as it takes off like this, interbank traders are watching that price level right there. And that's all I can say, and that's enough. So you anchor that there to the high going into New York. There it is. Everyone else on YouTube level will not see an optimal trade entry in this. They have no idea what to look for. They wouldn't even begin to think about what it is that I outlined for you tonight. If you go back to your price charts and start studying this idea, you'll see that it's been there all this time, but you've never noticed it. Until I talk to you tomorrow, be safe.